The five-year part of the Treasury curve seems to be outperforming. We saw consensus sort of coalescing in terms of yield curve control around the Fed perhaps targeting the two-year or five-year part of the curve. But then we did hear from Jeff Gundlach this week, who said if the 30-year becomes unhinged, gets to 2%, the Fed would step in to control that. You said back in March that yield curve control is next. How do you see it playing out if the Fed implements it this year?
Yes, I think it's linked to the forward guidance. In a way, it bolsters the forward guidance that they have underlined in this meeting. So the reference to keeping rates where they are through 2022, what that means is a sort of date-dependent forward guidance. So they've underwritten that here. That means that five-year bonds, fives become the new twos, because they've just locked down the two-year. The two-year is going nowhere because the two-year is linked to money, and they've just confirmed that. So you might as well buy the five-year, because in 2 years' time, it's a three-year piece of paper. And this is how it works. This is how it worked in Japan. This is how it worked in the Eurozone with the low for longer policies that have played out there. So I think that forward guidance is the main tool on top of the zero rates and the QE and the other programs at the moment. But the yield curve control might come in later. I don't think the Fed really wants to be targeting the 10-year or 30-year just yet, because it may be difficult to sustain a cap, especially on the 30-year, for a long period of time. They've got the experience of the 40s and the 50s, and they kind of unceremoniously came off of that cap. And they'll look around the world and see what's happening. In Australia, they chose the 3-year point. In Japan, they've managed the 10-year very well, but the difference is the BOJ owns most of the 10-year stock. With the US Fed, they don't own the belly of the curve. They're more spread across the curve, and the recent concentrations at the front end. So there's tactics and strategy playing out here. It's a bit early for the yield curve control. We wrote about it in March as being yield curve control next. And what we really meant was when the other tools have played out. So at the moment, they're focusing on forward guidance, and there's a lot more they can do on that. I was surprised, for example, that the committee, the collective view of the committee, left the long dot high. And to me, that looks borderline ridiculous. The idea that we're going to get anywhere near where they thought last December in the next few years, that doesn't seem possible. So they've got more things they can do. And you know, over time, that 2 year point will become the 3 and the 4 and the 5 year, because if in a year's time they're still saying in 2 years' time, it's like 3 years today.
So, Stephen, good morning to you. So that's Captain America. That's your view in terms of where they go on this curve control. One of the big plays in the market has been the steepeners. And Nejra and I, if you look at 10s, 30s, if you look at any of the curves, we have this steepness. I want to get a sense from you what's driving the steepness. On one side, and I put this question to a number of people, either it's the Treasury, it's issuance and the duration, the supply side, or it is the demand side, Stephen, which is a concern about stagflation, which tilts the 30s, or it is just that the risk, and it's a small one after this FOMC, is that the Fed would step back in any way. Your view on the steepener and whether we've run out of steam, sir?
Okay, I think we have run out of steam, and I'm not in favour of steepeners here. And the way the yield curve is behaving, as I said before, it's similar to Japan and the Eurozone. The flattening happens from the front first. So it's correct that the 5 year is the lead point, because money is flying up the curve from 2s into 5s. It's still going into 30s, but there's more going into the fives. It's easy to move from cash. If you're in a deposit account or money market fund, it's easy to get to twos or to fives. So that's logical. On the, you mentioned Captain America. That was the name of the paper about yield curve control we wrote 3 months ago. And the reason for the title, Captain America, was that we were referring to the 40s and 50s. And that's when the Fed and the Treasury worked very closely together to sell bonds. Now, Captain America was a Marvel comic character, and they used him and Bugs Bunny and other characters to sell bonds. The hero in the film was a bond salesperson. Can you believe it? So the point is, it was a patriotic duty to buy bonds. In answer to your demand and supply question, I think that people are having no problem buying bonds all across the curve. Precautionary savings has surged. And this is an interesting point about demand and supply, Manus, because I think people get the causalities wrong. They look at the Fed's balance sheet and they think there's a lot of money floating around. Actually, the Fed's balance sheet expansion by 2 trillion, or over 2 trillion to just above 7, that's been quite easily financed by the surge in bank deposits and money market funds. People are willing buyers. So in answer to your question, there's no lack of demand. And if there's one thing that frustrates me in all my meetings with clients, is this constant focus on supply. Because you can see the supply in the auctions, everyone thinks there's lots of paper coming, so the yield must go up. Well, that misses the demand, and the demand is there first, because people are saving because they're worried about the future. Those are people who are in jobs. How about the people that are not in a job? And he spoke about jobs a lot last night.